per share fair value. Remember that purchase price is the fair value. So $15 times 9,000 shares is our purchase price. On that date, Turner reported a net book value of $100,000. That's your second line of your DDES. You with me? We can, in your mind, are you creating the DDES? 9,000 times 15 is the top line. 100,000 is your second line. So that your excess is $35,000. Equipment, 5-year life, undervalued by 5. And a customer list, assessed value of $30,000. So you got a $35,000 excess. It's all been identified now. There's no goodwill. The customer list has a 10-year useful life. So 30,000 divided by 10 years is 3,000 a year. The equipment, 5,000 divided by 5 years is 1,000 a year. So we've got an amortization of $4,000 each year for the first 5 years. Any questions so far? You're getting to where you can process this a little more quickly. Following figures come from the individual accounting records of these two companies on December 31st, 2014. And then you've got 15. Okay, so part A says, what does the investment in Turner account show on December 31st, 2015 if we're using the equity method? Well, look at Turner's net income for the 2014. How much is it? 230 minus 120 is 110. So we would put the purchase price of 135 there. We would put the 110, the 50 for dividends. It's the subsidiary's dividends, right? In the parent's account. And the amortization was 4. And then we do that again for the next year. 130, you'd add 130, subtract 40, and again subtract 4. So that's what they did. They just didn't do it in a T account, but all of those numbers are right there. So again, memorizing this is still good for this chapter, which is why you need to do a brain dump on your test and put those 4 T accounts down lickety-split. And add in your deferred gain and your undeferred gain for chapter 1. And your deferred gain and undeferred gain for chapter 1. Then for chapter 2 and 3, you can just get rid of that again. Until chapter 5. Which you don't have.
Where'd you get the 110 from?
The 110 is Turner's 230 minus 120. Their net income. Revenues 230, expenses 120, 110. The next year, 280 minus 150 is 130. Got it? Yes, you do have to compute that, but sometimes they give you the net income, sometimes they give you what you need to compute the net income. The second one is what is consolidated net income for December 15. No matter which method they're using, it would be consolidated revenues, 700 plus 280, minus consolidated expenses, 460 plus 150 plus 4, don't forget your amortization, gives you 366. Consolidated revenues minus consolidated expenses equals consolidated net income. Are we good with that? All right, number C says, what is consolidated equipment balance? And how would this answer be affected by the investment method applied by the parent? It wouldn't. It'd be the same under all 3 methods. And so we would take the book value of Haynes, 500, plus the book value of Turner, 300, plus the DDES amount, which was, go back up to the DDES, and it was 5,000, minus however many years of amortization to date. There's 2. Minus 2. If you were doing the A entry, it would be, for 2015, it'd be 4,000 for the A, 1,000 credit for the E, which is an addition of 3,000. Add 5, take away 2. Right? It's 3,000. And then finally, Finally, if they apply the initial value method, what adjustment is needed to the beginning of the retained earnings? So initial value method, you would have to do this star C. So you would have 110, 4, 50. Which is 56. It would be 110, 4, and 50, and that would be the adjustment. Oops, backwards. Sorry. I like to leave it on the board so you can see I'm not changing anything. It's the same thing every time. The important thing is that you memorize this. You'd have a modified I. No D. How are we doing? That was 5, 15, and 16. I didn't do 25 or 29, but I did give you the worksheet for 29 and the answer to 29. Now we're going to do 31. So let's look at it. And you've got your worksheet. So we're going to do the worksheet for 31. I'm on page 135. On January 1st, 2014, Pinnacle Corporation exchanged $3.2 million cash for 100% of Strata Corporation. Pinnacle is the parent, Strata is the subsidiary.
On our test, did the parent start with a D?
I don't remember, but usually.
Because all the big ones do.
Almost always, or big and little.
This chapter has been mostly
P's and S's. Yeah, in real life, you know who the parent is, and you know who the subsidiary is. But here, these names mean nothing to you,
Right.
so they try to do it so that you have an idea. I think that's kind of nice of them. On the not necessarily in your multiple choice though. You will not always have that in your multiple choice, but on your worksheets they usually do. On the acquisition date, Strata had the following balance sheet. Strata was the subsidiary, right? So our book value, and it was January 1st. Our book value, we can just do common stock and retained earnings. 1.5 million, 1.1 million is 2.6 million. There's your book value. Or you could do your assets minus your liabilities, but then you'd have a whole lot more numbers. But since they did the assets, it'd be 5630 minus 375 and 286.55. But either way, you're going to get 2.6 million. So far, so good. They also have some, they transferred 3.2 million. The carrying amount, which is book value, 2.6. So they have an undervalued building and an overvalued licensing agreement. And it says the building has a 10-year life, so 300,000 divided by 10, just put out with the side 30,000 to finish your DDES off. And the 100,000 is 5 years. 100 divided by 5, 20. Negative 20. Goodwill, indefinite. Don't forget on your A, you're going to have to put that goodwill in there. The acquisition date, well, we already did that. At the end of the second year, the accounts payable included an $85,000 current liability owed to Pinnacle. Excuse me. Strata continues to operate, continues its separate legal existence, which means that it is 2 corporations legally, 1 corporation for accounting purposes, which means we have to do a consolidation worksheet. Pinnacle employs the initial value method. Now I knew that. How did I know that? Because the investment in Strata on page 136 is still 3.2 million. Went here, and it's still 3.2 million. I also knew it because my the bottom of page 135, dividend income for Pinnacle, even if it had said investment income, would have been 50,000 because the dividends on Strata are also 50,000. dividends of the son are the income of the father, the parent. Good? But they even told us the initial value. So you can write it down on your test. Is this initial value? Is this partial equity? Or is this equity? And I'll nod, yes or no. Don't say it out loud because then you're giving okay. So they're giving you 2015 numbers, and they ask you to prepare a worksheet. The first question we ask ourselves, what method? Initial value. The second, how many prior years? 1 and a current year. 1 prior, 1 current. You can write that down on your test if you want. 1 prior, 1 current. And so they want you to do a worksheet. You've got your worksheet. I'm going to go ahead and put the whole thing up here. Just don't cheat yourself, please. Let's do it together, okay? But I can point. Because it's initial value and we have a prior year, we do have a star C, a modified INOD. Sometimes, and we're not doing any more than star C and setup, but I will tell you that as I go forward, a lot of times I'll write my alphabet out. I'll write out what I need. I know now I need a star C. I need setup, but no D. So I would write in the margin somewhere, star C, SAI, modified, EP. That's what I would personally do, so I make sure that I get all of those on the consolidation worksheet. Okay, so the stars first. Prior year's net income. Do we have that? Do we have that? Do we have 2014 net income? No, so how would we get it? And the answer is, we look at the retained earnings of strata. And this is what I know about strata. I know that on the date of acquisition, strata had a $1.1 million retained earnings. And what else do I know? I know that on 1/115, strata has a $1.35 million retained earnings. It goes up for net income, it goes down for dividends. That's this, net income and dividends. I don't have the exact amounts, but I know those two things, do I not? Are $250,000. So I know that the net of that is $250,000. So I can't put all the 3 pieces, but I can put those 2 pieces together as 250. Right? And I also know my amortizations are 10, so I know my star C is 240. Okay? Can you do that? Of course you can. We don't always have every number given to us. In real life, I guess we could go find it. But here, they're just making sure that you understand how things fit together. So your star C increases the investment for this, 250 minus 10. Debit investment, so put it please onto your worksheet. Star C, debit investment, $240,000. Credit the parent's retained earnings, $240,000. Are you following? Here's your 240, and there's your 240. In this case, they put both of them on the same line. What we're adjusting right here with this 240 is that $5 million. Sometimes on 2 lines, sometimes 1 line. So that is adjusting that $5 million. These are in credits, that's a credit, that's why that's $5,240,000. It's not yet, because we haven't done setup yet. So the star C. So what I would do, I I would do the DDES. I answered my questions, initial value, one prior year. I did my DDES with the amortizations. I'm writing out my consolidation entries, and I would probably write them all out before I put any on, but since you've got it in front of you, I'm just gonna write one out at a time. Debit investment, credit retained earnings of the parent, 240. Now I'm ready to do setup, but remembering that it's initial value, modified item D. So my S entry, actually I'm gonna start. And by the way, that 240 is what the investment balance would have been if they'd been using equity method, right? So the S, subsidiary stock, we're gonna look for the subsidiaries, common stock and retained earnings at the beginning of the year. Make sure you do the beginning of the year. So it would be common stock, 1.5 million. Retained earnings beginning of the year, 1.35 million. And you add those up together and you get 2.85 million to the investment. There isn't any APIC in this particular problem. You would have APIC, but you're looking, you just look at the subsidiaries stock section, there's stockholders equity section, there's no APIC this time. The A, we have a prior year. We go back to our DDES. Okay, you have that somewhere. Do I have it anywhere? No, because it's in the book. That's right. The book has it. So in the book, you've got your DDS kind of, okay? And so you have buildings, 300,000 minus 1 year, right? And we had written out, yep, they were 10. So building is 300 minus 1 times 10,000, right? Or 30, 10 years, 30,000, 30,000. 1 prior year, 30,000 a year. 1 prior year, 30,000 a year, so this would be 270. Your licensing agreement is a credit, so I'm going to skip a line. Licensing agreement, on the DDES it was 100 minus 1 times 20,000, right? Is credit of 80,000, and it's a credit because it was overvalued. And don't forget your goodwill, which has not been impaired, of 400. And then net all that out, 470 minus 80 is the investment account. Is 390, I believe. No, it was 400. 670 minus 80. Hello. That's a 5.
Yeah, I was wondering where you got the 470.
Whatever. Right? I just can't add and subtract.
I can walk, right?
There
And
you go.
breathe.
There. Yeah.
And think.
But I don't have coffee this time, so I can't join in on that. And then we put that on there, right? Everybody okay? Derek? Eric? Sophia? Jesse? Casey?
Sure.
Good. The I is a modified I. We eliminate the dividends against the dividend income. So you can look and you see the parents got dividend income of 50, and the subsidiary, so dividend income is removed and dividends are removed. This is your modified I.
Oh,
No D, because the D is the I. You could debit dividend income credit investment, and on the I you could debit investment and credit dividends. But why? They'd be $50,000 and you just have a debit and a credit in the investment you don't need. Modified I, no D. The E, and then we put that on there. The E is our 20,000 and our 30,000, so we've got, yeah, buildings get a credit of, no, licensing agreement gets a debit of 20. Building gets a credit of 30. The licensing agreement is amortization expense. Depreciation expense for 30. There you go. And you put it on your worksheet. Debit depreciation expense 30, credit amortization 20. Yeah. Anytime you have an A, except for land and goodwill and anything with an indefinite life, you got an E on the other side. So in this case, if you're not real sure, you know that you had an A on buildings that was a debit, so your E's got to be a credit. And your licensing agreement, I don't have that hooked up. Your licensing agreement is a credit. Your A is a credit. So your E is a debit. It's the other side. It reduces it. And it's not your DDES amount, it's DDES minus prior years times amortization or depreciation per year. Got it? And then P, does it say anything about a P? I don't think so. Oh yeah, it does somewhere. Let me read it to you, let me find it. Underneath the DDES they have in the book, at the acquisition date, Stratus Buildings had a 10-year remaining life. Licensing agreements were due to expire 5 years. The next sentence. At December 31st, 2015, Stratus account payable included an $85,000 current liability owed to Pinnacle. We got to get rid of it. That's your P. Is always a reduce accounts payable, reduce accounts receivable. It's no matter who owes whom, it's a debit to accounts payable and a credit to accounts receivable. In this case, 85. And we call that, when it is accounts receivable here, it is accounts payable there. Sometimes it says current assets and current liabilities. Okay? And we put those on the worksheet. How are we doing? Are you ready to finish the worksheet? Who needs a minute? Got it.
So does the star C basically like eliminate like the I in this one, or?
No, the star C converts it to equity. Initial value does two things differently. Star C, which is the three components, and modified I, no D.
Okay.
The partial equity does a star C, just amortizations of prior years, no modified I. And once we got the star C, and if we need it, the modified I, we're ready to finish the setup.
Where did you get the 85 for the P?
It's in your book. Right.
Oh,
It has to be in the verbiage, or else it would have to be on here, which there could be a separate account that could say accounts receivable from the subsidiary, accounts payable to the parent, one or the other. It's either got to be a separate line or it's got to be a sentence. There's no other way to know. But whatever it is, it's a reduction to the payable and a reduction to the receivable, no matter who owes whom. Because you need to eliminate that. You can't You see right, they're both on there, you can't owe yourself. That's why we're removing it. Wow, that was quick. Yes, ma'am.
And what's the formula for the book value again? The
Book value is either assets minus liabilities, or the stockholder's equity, which would be common stock, APIC, and retained earnings. Or it's given as book value.
book value.
Yeah.
Yeah. Okay.
So, it's just one of those, remember that? I wrote that on there, and there were 4 net assets,
Can we like?
which is assets minus liabilities.
Yeah. Can we get the book value from the carrying amount or others?
Carrying value of net assets is book value.
Okay.
Just a lot of different ways of saying it. So again, I'm here to give you the nod or the no on your test, okay? And so you can just say, is this book value?
Or can we use fair value to get the book
No.
value?
Fair value, in this problem, fair value would be all but the 400,000. Because fair value includes the under and over valuations. It includes the excess.
Okay.
So the difference between purchase price or consideration transfer and fair value is goodwill.
Oh.
The difference between, so in this case, 3.2 million minus 3 million is goodwill of 400,000 or 2.8 million. So no, it's not the fair value of the net assets.
Okay.
But if all you were asked for is goodwill, you can use fair value,
Yes.
right?
Yes.
Okay. Fair value includes under and over valuations, specifically identifiable. Okay, now I've got extra time, and now I'm trying to figure out what I'm going to do now.
Will you give us the worksheet like this one on the test? Or-
Yes,
Okay.
I will. You will have the shell with the lines and everything with credits in brackets.
Including the T account?
No,
That's not in the,
no, all I would do is just the shell.
but
Just the,
will you grade as our T account?
yes, I will. I will have, obviously, if you get, what I'm hoping is that you've got consolidated assets and consolidated liabilities and equities, the same number, and it's the right number. If that's right, all I do is go check, 75 points.
And do I do the journal entries?
Yes, because if you don't have the right numbers, I give you partial credit.
Okay, I see.
So you want the DDES written out, right? So I can check it. You want your consolidation entries written out so I can check them and I can tell you, oh, your A is wrong or whatever. You see what I'm saying? If you've got everything right, I don't have to do anything but just give you 75 out of 75. But if you don't have it all the way right, I want to be able to give you as many points as I can give you, but you gotta have a partial credit. I mean, you gotta have all the details.
And also, where do we use the how many previous years in the whole?
Use it in A,
Mhm. Yeah.
you use it in the star C. I think that's all
Okay.
through chapter 3.
And I have a stupid question. Is chapter 3 including chapter 1 and 2? Okay.
It all builds, doesn't it? It's cumulative.
Okay.
So your final is not just chapter 3, it is chapters 1, 2, and 3. And there will be some, I mean, you know that, you've got your review sheet, right? Any questions on the review sheet?
So mainly focusing on that sheet.
Okay, so what's your pleasure? Now we have 27 minutes.
I need a spreadsheet of all the steps,
Okay.
and it's based off equity method, I'm guessing you could say it is. But I have like, you determine what it is, then you have DDES with the process of finding everything, with the 2T account, so investment income, and then setup. And then we just have to know basically the
I used to do that. I used to have what the, I don't know if I still have that. Probably in my chapter 4 outline, I have that same kind of thing. And if you want me to, I can check that for you.
And can we have the T account of investment and the investment income, all the entities, like, we have to consider?
The only other thing that you would have here is, last year gain on inventory and this year gain on inventory, because you're deferring, you're undeferring, and this year gain on inventory and last year gain on inventory. This would be for chapter 1. That's the only thing that I would add to chapter, to the
Is
T
this amortization under percentage of dividend?
account.
This
Amortization is our share.
our share.
So, going back to chapter 1, you have to take, let's say it's 40%. From the DDES, the amortization is 100% of the DDES. We don't take that times 40%, because that DDES is our 40%.
Okay.
But our net income and our dividends is 40%,
Oh,
right?
yeah.
So you have to kind of remember that back in chapter 1. So by the time we get to chapters 2 and 3, this is 100% and 100%.
Okay. I see.
But if we were doing chapter 4, we'd be back to the percent of net income and percent of dividends again,
Okay.
because it's non-controlling interest, minority interest. Other questions? Would you like to do another worksheet?
Yes.
Okay, I believe you have 29.
Can we go through it kind of like what we would do for the test, like our process of it? So
Yeah.
just basically break
Yep.
it
Cause
all
I don't know
down.
how you guys feel, but like once I get all the numbers, like the worksheet and footing it isn't the big deal, but it's like the 4 steps, not steps
To
1
get
and 2,
there.
but it's steps like making sure you get the DDS, the
Ask
right
your
journal
questions.
entries, and the set.
Okay, here are your steps.
Oh, I know the steps. It's one, like I got that. It's just
Okay.
really steps.
But let's apply them to this problem.
Yeah, just kind of
Okay.
like,
All right,
Which
we
one?
do it.
I can do that.
Which one are we doing?
We're doing 29, and you should have that, but it doesn't have the lines on it yet, I'm sorry.
I know that sometimes.
We got it last class.
Yes, I gave it to you last class, and I gave you the answers today to that one. So let me let you dig it out.
Just have a worksheet.
Now, we only have like 23 minutes, so I'm gonna go ahead and get started. If we have time to finish and put everything on the worksheet, fine, but if not, you can finish the worksheet later on your own, okay, with lines and all. Okay, so let's get started on it to use our time wisely. Number 29, following are separate financial statements of Michael and Aaron. Okay, so here we don't have a P and an S. Michael is parent, Aaron is subsidiary. As of December 31st, 2015, Michael acquired Aaron's 100%, all of, on January 1st, 2011, by issuing 20,000 shares of its own, $1 par. We don't care about par, except when we're doing that original journal entry. And it actively traded at $23.50. So,
There's a
pardon me? Yeah, there was APIC back in 11. We're doing the consolidation for 15. So far, so good. Step number 1, which method are we applying? Well, let's multiply $23.50 times 20,000 shares is how much? 470?
Yeah.
Okay, so let's apply those 2 steps that I had here. What is the investment 5 or 4 years later?
initial value.
It's still 470. This is initial value,
One current year. And 4
right?
prior.
It has not changed. We also see that the dividends that they declared and paid for Aaron, 5,000, is the same dividend income on Michael, 5,000. You got that? So we know it's initial value. Initial value, how many prior years? 11, 12, 13, 14. 4 prior years and the current year. 4 and 1. So far, far so good.
If the dividends didn't match, what would that mean?
That would mean something's wrong. It should. It's just confirmation that we're using initial value.
But if they don't match, then it's
If
not
they don't match,
initial
then it's
value.
not initial value, it just hasn't, that's impossible.
Okay, gotcha.
That would mean they'd have no net, or they had net income equal to dividends every year or something, and they're using partial equity. It's not gonna happen. But it's confirmation. On the date of acquisition, Aaron reported retained earnings of $230, had a book value of $360. So there's our second line in our DDES. So now we've got, answer our question, initial value for prior years. Now we're ready to do our DDES. You have that. I gave you the answer to this. So you've got your DDES somewhere, I believe. Maybe not. Maybe I'm telling you a story. Nope, there it is. It is page 33. At the bottom, you know, your pages are numbered. 3-33 in the solutions manual has your DDES on it. There's your 470 and the 360. They told us everybody got what I'm talking about? Derek, good?
I just got it.
Okay, 3-33 that I passed out to you. Eric got yours? Okay. Everybody found what I'm talking about?
Is this the DDES?
Look at the very bottom of that page. It says 3-33, right?
Yes.
Okay. Yes, that's the DDES. They don't do it exactly like we did, but I will do it exactly like we've been doing it, okay? All right, purchase price or consideration transfer. We said $470,000, which is the $23.50 times the 20,000 shares, right? The book value, bless you, was given to you as $360. We determine our excess to be $110. And then they tell you, at that time, royalty agreements were undervalued by 60. So royalty, 60. Intangible had a 6-year life. Divided by 6 is 10 each year. A trademark with a $50,000 fair value was not reflected. That was so trademark is undervalued by 50. And it has a 10-year remaining life. That is $110,000. Therefore, our goodwill is nothing. Are we good? That's the DDES like we do. But you've got kind of it, kind of. So far, so good.
Where do we use the 15?
That's in your E.
Okay. E.
Your E entry is going to do that. And you're going to use the 10 times the prior 4 prior years in your A.
Okay. Yeah.
And the 5 in your A.
Are you still just doing current year for E? Or is that only for
E
equity?
is always the current year.
Okay.
The A accounts for the prior years. So since we have 4 prior years, 60 minus 40, that's going to be 20. And 50 minus 20 is going to be 30. But the E is going to be the 10, the 5, and the 15. The E is 1 year.
And it's not depreciation expense, it's amortization.
Both of these will be amortizations because they're both intangibles.
But what would the credit be again for E?
Royalty and trademark.
And the debit would be
Amortization expense.
Okay.
Are you getting there? Is it coming clearer as we do it more and more? Which is why you're going to do it more and more and more and more. All right, what else do I know? Using that, prepare a consolidation worksheet. Okay, it's initial value, so we have a star C. Now we don't have here the details of what happened for the prior years, but we do have retained earnings. That's why they told us that the date of acquisition, their retained earnings was $230. So Aaron's retained earnings on what was the date they bought it, 1/1/11,
Mhm.
was, they tell you this, where is it, is
Underneath the thing.
230, on page 134. What I do also know is that 1/1/15, where do I find that? It's not the 635,
No,
what is it?
Where is it?
490.
490. It's on the statement of retained earnings, the middle section, okay? 490. So what do I know? I know that net income minus dividends for those 4 years is equal to the difference between that, 260. So my star C is that 260 net income minus dividends for the prior years minus amortization for the prior years. I'm 15 per year. There are 4 prior years. My star C is $200,000. And it is always a debit to investment and a credit to the retained earnings of the parent at the beginning of the year. As though they've been using equity method all along.
Feeling you get when you make it up, or it don't make sense.
Finally, the little light bulbs are starting to
Well,
click.
she just did like a little dance. And you just, like,
Happy dance, we're having happy
Yeah.
dance moment. All right, what's next? So now we're ready to do setup. It's initial value, so we have a modified I no D. I'm gonna write out my journal entries, but because it's all there in front of you, first of all, I'm gonna take this off. So my S, it's subsidiary stock. The source is the worksheet. You go and you look at we do have common stock, APIC, and retained earnings. It's the 100, the 30, and the 490, not the 635. Yes? Okay. So common stock. See how much y'all learned in just such a short time? 100, 30, and retained earnings beginning of the year. All subsidiary accounts for 90. You add those up, and you get 620, I think. Is that right? Yeah. That's your S. Slow me down. We've still got about 15 minutes, so slow me down if I'm going too fast. Good? The A is going to consider our 4 prior years. We're going to go, the A stands for allocations of the DDES. Our source is the DDES. We do 60 minus 4 prior years for the royalty. 60 minus 40 is 20. The trademark, 50 minus 20 is 30. And don't forget your goodwill, it's 0, so we don't have to worry about it this time. And investment, the sum, 50.
Goodwill would have been a debit.
It would have been. Okay. We have a modified I because it's initial value, and no D.
What two numbers did you get for the 30 again and trademark
50
minus?
minus 5 times 4,
Okay.
4 years. 5 times 4 years, 20. 50 minus 20 is 30. Modified INOD, we look at either the dividend income or the dividends, because that's what we're doing, is getting rid of both of them. Dividend income. Is it 50? Thank you. And dividends declared or dividends paid and declared. We're not worried about what if they didn't pay them when they didn't, whatever. It's really dividends declared, because that's what affects, and that may mean that there's a dividends payable, but if that's the case, that's part of our P. Dividends payable receivable would be part of our P. Because it'd be payable to the parent. You see what I'm saying? You will not have that. SAI, modified INOD. The E, expensive amortization, the 10,515. Both of those are amortization expense. Is 15,000. Royalties get credited 10, and trademark gets credited 5. Everywhere you have an A, the E's on the other side. You got an A here, debit, E there, credit. A, E. Do we have a P? I'm not seeing one. So I didn't read all the way through that problem, but you'd have to read through. And so you're welcome to write down on your test. If you don't see a P anywhere, say no P, question mark, and I'll nod, okay?
What's the previous year for the A again for royalty? How do we
Where?
for A?
For A?
Yes, the royalty.
Royalty is the original 60,000 minus 6,000, or excuse me, 10,000 is your annual amortization, times 4 prior years. 4 prior
Oh,
years.
I
You're
see.
using your prior years. And this is 50,000 minus 5,000 times 4 prior years.
Okay.
Better?
Yes.
And now the next step, we put all those onto our worksheet. We make sure that 890 equals 890. Then we know we haven't put anything on the wrong side. Okay. 610 plus 370 is 980. 270 plus 140 is 410. 115 plus 80 plus 15 equals 210. 5 minus 5 is 0. This is a credit. This is a debit. That should be 0. Your earnings should be 0 and your investment should be 0. Always, 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 always. Those two. If nothing else, if you can't get the thing to balance, put zeros there and you'll get points.
That's supposed to be 50, not 5.
Oh, yeah, the I should be 5,000, right?
Ah, yeah, there's a typo there.
Wait,
How'd they do that?
wait,
I thought
should
it
R,
be 50.
Is it 50 or 5?
Oh, it's 5. We looked at the wrong
It's 5.
thing.
Oh,
Yeah.
then it is 5. Let's take a 0 off here. Good. There we go.
The I.
We looked at the parents' dividends. It was the subsidiaries' dividends we needed, not the parents.
Mhm.
Dividends are, yeah. The other problem, it was 50.
Yeah, we looked at the wrong.
And I kept looking, I'm doing my $1 million duck here. Okay.
It's one of those.
All right, so we've got that, and we foot down
Mhm.
and get 360, and we put it there. Everybody confirm this? Then we do 880, adjust it for the 200. This is a credit. This is a credit, so that's a bigger credit. It's real easy to screw that one up, right? But you're always you're not always adding. If it was partial equity, you would be subtracting. You'd have a credit and a debit. Okay. This 490 minus 490 is nothing. The subsidiaries retained earnings has gone away, but sometimes they're on the same line. Okay? Then 230 plus 150 is 360. 90 plus 5 minus 5 is 90. Should be just the parent. We add down and get $13.50. That is consolidated retained earnings into the year. This is consolidated net income for the year, thank you. We take that number and we put it down. 110 plus 15, 125, 380 plus 220, 600, 560 plus 280, 840. The 470 adjusted for all of that makes it a 0, always. 460 plus 340, 920 plus 380 plus 20 minus 10 is 1310. 0 plus 30 minus 5 is 25. We add down. 780 plus 470 is 1250. 300 plus 0 is 300. 500 plus 100 minus 100. Credit, credit, debit. So sometimes I'll come to you on your test and say, credit, credit, debit. Okay. Is 500, which is just the parent. APIC, just the parent. Retained earnings came from above, add down, and those two numbers equal. If you can't get it to balance, make sure these two equal. You get points for that.
Which two? Oh, okay.
Make sure you've put it down, you get credit for that. Everything there's like 75 points, of which maybe 5 to 7 is the DDES. 1 for each entry, debit or credit, 1 for each number, 1 for the fact that you put it down. You see what I'm saying? I just break it down into the number of possible points.
When you say it's just the parent, is this all the worksheets are just the parent or this one? And the just the parents will be the dividends declared, common stock and EPIC, and more? No.
Well, they have preferred stock here, but the subsidiary didn't have preferred stock. Chapter 7,
It has preferred stock here.
so you don't have to worry about subsidiary's preferred stock.
And
Because I will tell you that subsidiary preferred stock, sometimes the parent owns it, sometimes they don't.
okay.
We have 2 DDESs, we have 2 A's, 2 E's. It gets a little bit more involved. You don't have to worry about it. Yay!
And retained earning and investment will always be 0.
Retained earnings,
And investment.
not retained earnings, but the earnings, the investment earnings or the dividend income, that earnings in the income statement where the parent has earnings from their subsidiary, that will be 0.
That,
And the investment will be 0.
okay. Do we have other rules of the totals? Okay, I see.
Nope, but always remember, foot down for the double underline and put her there. Foot down and put her there. Right? You've done this. Just as soon as possible, do another one. Do another one. Right? Try to do 1 a day. Does that make sense? Even if you have to print, on out of your Connect, because they're going to be hopefully algorithmic. Do another one. Do another one. Do another one. You have a question?
Which one? What are the ones that you add down, not across again? Just
Double everything that's double
double
underlined.
line? Okay.
And so you were, I may not have that double underlined, but
Yeah.
these will be double underlined. See how on your shell?
Yeah, I just wanted to make sure.
So
that
make
those
sure
are
you
the
double
only four.
underline, if I forget to, because
Okay.
sometimes I just, but the double underlines are down and put her there, down and put her there. More questions? You're gonna do just fine. You're gonna do fine. It's just a matter of
I focus
practice.
so much
On the
three-
worksheet?
On 3 that I forget what's even in 1 and 2.
Well, 1 and 2 kind of goes into 3.
But it is cumulative.
isn't
The
one-
only thing in
isn't
1
one-
that's new, that's not in 2 and 3,
Under 3.
is the game. Times, times, times.
Well, can't, what is it, 1 or 2, you can have percentage of the company? Not.
100%. I think
Yeah.
1 is for.
1 is not 100%, and it's
Yeah.
below 50 because we're not consolidating.
Okay.
It's below control. Chapter 1 was something below 50. And if it's below 20, you use the initial value method or the cost method. If it's above 50, you obviously should use the equity method. But and you should consolidate. If it's between 20 and 50, you use the equity method if you have the ability to exercise significant influence, which you assume at 40% or whatever. Above, whatever. Okay? You're gonna do just fine. Just go practice, practice, practice makes perfect.
So if it doesn't have